Hey everybody, Ryan and Matt here with Duckett Ladd Dental CPAs, and today we are talking about that special window in between January 1st and April 15th of things that you can still do and apply it to prior year. So there are still some tax things you can do right now before April 15th that you can apply back to the previous calendar year. So Matt, why don't you start us off with IRA contributions?
Yeah, sure. So the most common opportunity I think still available in this special window is that IRA contribution. You can contribute to a traditional or Roth for 2025 all the way up until April 15th. So that's $7,000 per person, or 8,000 if you are 50 or older. So if you were married, that could be 14 to $16,000 of retirement contributions you could be leaving on the table. Important to mention, though, that income limits do matter here. So if you're a high earning dentist, you likely phase out of a direct Roth contribution. But depending on your situation, a backdoor Roth could be available if it is structured correctly.
Yeah, and one thing to keep in mind on that backdoor Roth, if you make your contribution right now, in March, let's say, and apply it to previous year, but you do the Roth conversion in 2026, the contribution will be attributed to 25, but the Roth conversion technically won't happen until 26 and be on your 26 tax return. Um, so Matt, what about the next one? HSA contributions.
Yeah, I like this one because it's the kind of the only strategy I can think of that has that triple advantage. So, health savings account, HSA, powerful option, does require a little bit more foresight and planning than that Roth contribution because you do have to have a qualifying high deductible health plan in place on December 31st of 2025. But you can still fully fund that HSA up until that April 15th deadline. So if you have family coverage in 2025, the maximum contribution there was $8,550. That could be several thousands of dollars in deductible contributions. So again, they're triple tax advantaged. Money's deductible going in, the growth is tax free, and as long as the funds are withdrawn for qualified medical expenses, those withdrawals are tax free as well.
Yeah, that's great. How about retirement contribution plans for like an actual retirement account that your practice might have?
Yeah, so there's a few here, really more than a few, but I'm just going to touch on three or four of them. First one, SEP IRA contributions. They can typically still be made up to the extended filing deadline. So September 15th, if the return's extended, but the plan's got to be properly set up. Solo 401ks, another popular one, again, generally needs to have been established by December 31st, but those profit sharing contributions can still be funded up until that filing deadline or extension deadline. And then you have your defined benefit and cash balance plans, which we'd like to work with financial advisors on for sure, because they have even stricter timing rules. They require some more advanced planning. But I guess the key point here is that April gives you fewer options than December did, but there could be still some meaningful contributions available depending on what you had in place in December.
Great. Anything else out there, Matt, that clients can be looking at doing now to help with their previous year tax situation?
Yeah, so we have a lot of dental practices set up as S corporations, and there's a lot of boxes to check there to make sure everything's in compliance. So we review things like whether reasonable compensation was properly structured. And we can't go back in the past and create wages, but we can still make sure that distributions and basis, things like that, are in line before we file the return. And we also look at things like missed accountable plan reimbursements for things like auto expenses, retirement contribution allocations, kind of the accuracy and amounts of those, and then the proper documentation and imputing of interest on shareholder loans if we have to get into all that. So, it's not really about creating new deductions. Sometimes it's kind of tightening up compliance and preventing future issues.
Yeah. So those are also great tips. Um, just to kind of reiterate, what are some things that can't happen after 12/31?
Yeah, so I mean, unless you have a time machine, you can't go back and buy equipment and apply it to 2025. You couldn't start a brand new retirement plan in this year and fund it retroactively. Things like entity elections for 2025 can't change. Restructuring your compensation, all those decisions needed to happen in 2025. So the April planning more about optimizing, not about creating.
Yeah, so those are all fantastic tips, Matt. So kind of the main points here. If it is before April 15th, you still can go back, make those IRA contributions, put them on the prior year if you still can, get that tax deduction, max out your HSA if you have one. But again, the key is make sure you were into that high deductible plan by the end of the year. And then, of course, if you're working with a financial advisor and have a retirement plan in place, get those contributions made, and we can put those on your previous year tax return as long as you make those before the extended deadline. So, Matt, some great tips there. Appreciate everything that you brought to the table.
See you next time.
All right.